6:29 a.m. After the rout in Asia, investors in Europe are bracing themselves. Spreadbetters expected Europe markets to start lower, forecasting an 0.8% drop for the FTSE, and declines of 0.2% for Germany's DAX and France's CAC. 6:26 a.m. Trading in Japan has closed. The Nikkei index fell 2.32%, or 508.24 points, to close at 21,382.62, while the broader Topix index was down 1.91%, or 33.72 points, at 1,731.97. 5:16 a.m. 5:02 a.m. Jim Rogers, a veteran investor, says the next bear market in stocks will be more catastrophic than any other market downturn that he's lived through. The 75-year-old chairman of Rogers Holdings Inc. says that's because even more debt has accumulated in the global economy since the financial crisis, especially in the U.S. While Rogers isn't saying that stocks are poised to enter bear territory now, or making any claim to know when they will, he told Bloomberg that he's not surprised that U.S. Equities resumed their sell-off on Thursday and he expects the rout to continue. When we have a bear market again, and we are going to have a bear market again, it will be the worst in our lifetime. Debt is everywhere, and it's much, much higher now. 2:58 a.m. Shanghai is faring worst so far in Asia, with a plunge of 5.7%. Commenting on the market slide, Doug Coate, chief market strategist at Voya Investment Management, told Bloomberg News, "There's some big money players that have really leveraged to the low rates forever, and they have to unwind those trades. They could be in panic mode right now." Japan's Nikkei is now at levels not seen since mid-October and Hong Kong is on course to wipe out its 2018 gains. Elsewhere, Sydney fell 1.3%, Singapore shed 1.6%, and Seoul was more than 2% off. Wellington, Manila and Taipei were also being battered. 1:41 a.m. Hong Kong has joined the rout in early trade, with the Hang Seng plunging 2.83%, or 862.06 points, to 29,589.21. 12:43 a.m. Correction is the word of the day, with a 10% drop on the Dow and the Standard. So how long will this last? Masahiro Ichikawa, senior strategist at Sumitomo Mitsui Asset Management in Tokyo, told Reuters it might not stop any time soon. The correction phase in equities could last through February and possibly into March. The rise in long-term U.S. yields will have to settle for the correction phase to end. The surge in volatility has also prompted investors to sell risk assets, in turn feeding more volatility. 12:15 a.m. Japan's markets have opened and have followed Australia's lead. Tokyo stocks have dropped more than 3% in early trade. The benchmark Nikkei index fell 3.4%, while the broader Topix index was down 3.05%. 11:44 p.m. As expected, Australia's S. In New Zealand, the S. 10:54 p.m. Japan's Nikkei, Hong Kong's Hang Seng and the Australian S. On Tuesday, all three indices fell, with the Nikkei dipping as low as 7.1% but paring losses to close down 4.7%, while the Hang Seng ended the day 5.1% lower and the S. Nikkei over the past week. 10:24 p.m. Analysts gave their take on the U.S. sell-off late on Thursday, with some seeing this as a return to normality, while others warned the plunge may not be over. Brian Battle, of Performance Trust Capital Partners, said the rise and fall was reasonable. This is going to be typical. Hooray, volatility is back. The volatility is back. This is a more normal trade. A one-way trade is not normal. Markets are supposed to go up and down. This is reasonable. Randy Frederick, the vice president at Charles Schwab. I really don't like how this market look like right now. I don't think we're done with the rout. The bounce that we got a couple of days in equities was just a trap for people to buy into. I've been telling people to wait for 2 solid up days and a drop in volatility. I think there is another downturn and another VIX spike coming. Part of this might have to do with short volatility strategies. We haven't heard enough about those and I think there is more damage out there. With interest rates rising, it's only going to make the thing worse. 10:04 p.m. Donald Trump made a mistake by claiming responsibility for the recent U.S. equity rally. Markets go down as well as up, and this bull market is very much long in the tooth. If he took credit for the gains, he will need to take responsibility for the falls when they come. But, luckily for him, I think there's life in the old bull yet, writes Gary White. This week's wobble was not the end of the 8-year bull market, it was a healthy correction in equities that have been overbought. Nothing has fundamentally changed and the falls were exacerbated by algorithms reacting to the increase in volatility. Read the piece in here. 9:47 p.m. Another day, another sell-off on Wall Street. Dow plunges again more than 1,000 points as volatility spikes again. The VIX is back up to 30, against the backdrop of another move higher in rates, albeit muted somewhat by the move down in equities, and in a bit of a macro news vacuum. pic.twitter.com/GNSCZTWHSF, Holger Z. Chapitz, Upschild and Swainer, February 8, 2018. Today's sell-off on Wall Street comes in the wake of Friday's U.S. jobs figures, which showed wages were rising at the fastest pace since the Great Recession and jobs growth reached 200,000. Markets are concerned that the stronger jobs environment will cause the Fed to hike interest rates, which in turn will drag down economic growth. For a recap of what happened late last week, here's our piece in 9:20 p.m. Thursday saw a late sell-off in the U.S., which accelerated just before the close, causing all three major equities gauges in the country to plunge. European equities had ended the day lower, with the FTSE closing down 1.4% as the Bank of England hinted an early rate rise was needed to curb rising prices amid stronger economic growth.